RTX Corporation, ticker RTX, has recently pulled back from its all-time high, raising an important question for investors. Is RTX actually crashing, or is this simply a healthy correction and a potential buying opportunity? RTX reached an all-time high of $226.88 on August 10, 2026, before falling to $209.91 by August 21st. That puts the stock roughly 7.5% below its recent high. In this video, we will examine RTX's fundamentals, growth drivers, risks, valuation, and finally establish bear, base, and bull price targets for 2027. RTX recently reached approximately $227 before pulling back toward the $210 area. A decline of roughly 7% to 8% from a recent high does not automatically mean the business is collapsing. After a strong rally, profit-taking and valuation compression are normal. The key question is whether RTX's earnings, cash flow, backlog, and future outlook are deteriorating. Based on the latest second quarter results, the fundamental picture remains strong rather than suggesting a business in crisis. RTX is one of the world's major aerospace and defense companies, with businesses spanning Pratt & Whitney, Collins Aerospace, and Raytheon. This gives RTX exposure to several powerful long-term trends at the same time. Commercial aviation continues to recover. Airlines need new and more efficient aircraft. Aircraft maintenance demand remains strong, and governments around the world are increasing defense spending. This combination makes RTX more diversified than a pure defense contractor or a pure aerospace company. One of the strongest parts of the RTX investment story is its enormous backlog. RTX reported a total backlog of approximately $289 billion at the end of second quarter 2026, including $170 billion of commercial backlog and $119 billion of defense backlog. Total backlog was up 22% year over year. This gives the company significant visibility into future revenue. A backlog does not automatically become profit, and investors should never treat the entire backlog as guaranteed earnings. However, it does provide an important advantage because RTX does not have to depend entirely on winning new contracts every quarter. Commercial aerospace could become one of RTX's biggest long-term growth engines. Pratt & Whitney and Collins Aerospace benefit from increasing aircraft utilization, aftermarket services, maintenance, and new aircraft production. As global passenger traffic expands, airlines need more engines, components, repairs, and maintenance services. This creates a recurring aftermarket opportunity that can potentially generate attractive margins over the life of an aircraft. The latest second quarter results showed strong growth across RTX's businesses, with Pratt & Whitney sales increasing 16% year over year and Collins Aerospace also delivering solid growth. The defense business gives RTX another powerful growth opportunity. Raytheon participates in missile defense, air defense, precision weapons, radar, and other critical military technologies. Global geopolitical tensions and rising defense budgets could support long-term demand. One major recent catalyst is Raytheon's approximately $22.9 billion Tomahawk missile contract with the U.S. Navy. This type of large defense award demonstrates the scale of demand that RTX could capture as governments increase spending on missiles and other defense systems. RTX's latest financial performance is another important reason why the long-term thesis remains attractive. In second quarter 2026, RTX generated $24.7 billion of sales, representing 14% year-over-year growth. Adjusted EPS reached $1.89, up 21% year-over-year, while free cash flow reached $2.9 billion. For the full year 2026, RTX raised its adjusted sales outlook to $95 to $96 billion, adjusted EPS guidance to $7.10 to $7.25, and free cash flow guidance to $8.50 to $8.75 billion. The guidance increase is important because it suggests management is seeing continued strength in demand and execution. So, is RTX crashing? Based on the current fundamental picture, I would say no. A 7% to 8% pullback from a recent high is better described as a correction rather than a fundamental collapse. A real crash would typically involve a major deterioration in earnings expectations, a collapsing backlog, serious cash flow problems, or a major structural issue within the business. Right now, RTX is still reporting strong sales growth, rising earnings, strong free cash flow, and record backlog levels. Therefore, the recent decline looks more like a pullback after a strong rally than a fundamental breakdown. However, RTX is not risk-free. The biggest concern is valuation. After its powerful rally, investors are already paying a premium for RTX's quality, backlog, aerospace exposure, and defense positioning. If earnings growth slows, the market could compress the valuation multiple even if the company remains fundamentally strong. This means investors should avoid assuming that a great company automatically becomes a great investment at any price. Valuation and entry points still matter. Let's start with the bear case. If commercial aerospace growth slows, defense spending disappoints, margins fail to expand, or the broader market experiences a major valuation correction, RTX could fall toward the $175 to $190 range. In this scenario, the company could still remain a strong aerospace and defense business, but investors would be willing to pay a lower valuation multiple. This is why position sizing remains important even for a high-quality company. In my base case, RTX continues growing revenue, free cash flow improves, the backlog remains strong, and aerospace and defense demand stay healthy. Under those assumptions, I believe a 2027 price range of approximately $245 to $270 is reasonable. My central base case target would be around $260. From a price near $210, that would represent approximately 24% upside, excluding dividends. Now let's look at the bull case. If global defense spending remains elevated, commercial aerospace demand continues accelerating, Pratt & Whitney improves its execution, Collins Aerospace maintains strong aftermarket growth, and RTX expands margins while generating stronger free cash flow, the stock could potentially reach $300 to $330 by 2027. A $320 target would represent roughly 52% upside from the $210 area. There is also an extreme bullish scenario where RTX could move above $350. But I would not use that as the primary target. To justify such a valuation, RTX would likely need several things to go right simultaneously: strong aerospace growth, sustained defense demand, significant margin expansion, higher free cash flow, and continued investor willingness to pay a premium multiple. It is possible, but it requires a much more optimistic set of assumptions. So, where would I consider buying? Around $205 to $210, I would consider a small starter position rather than going all in. Around $195 to $200, the risk reward becomes more attractive. If RTX falls toward $180 to $190 without a major deterioration in its fundamentals, that could represent a significantly stronger long-term entry opportunity. The strategy I prefer here is staggered buying rather than trying to put the exact bottom. There are several things investors should monitor going forward. Watch RTX's backlog growth, commercial aerospace demand, Pratt & Whitney execution, defense contract wins, operating margins, free cash flow, and management's guidance. If these metrics continue improving, the long-term bullish thesis becomes stronger. But if backlog growth reverses, free cash flow weakens materially, or management cuts guidance, investors should reconsider the valuation and price targets. My overall view is that RTX does not currently look like a crashing company. It looks more like a high-quality aerospace and defense company experiencing a normal correction after a strong run. At around $210, I would call RTX a potential buy-the-dip candidate, but not an aggressive all-in buy, because valuation still matters. My 2027 framework is approximately $180 for the bear case, $260 for the base case, and $320 for the bull case. If you believe aerospace travel will continue growing, global defense spending will remain elevated, and RTX can convert its enormous backlog into higher revenue. Free cash flow. The current pullback could eventually look like an attractive entry point. But if valuation becomes too expensive or the fundamental growth story weakens, the downside can still be significant. So the real question isn't simply, is RTX crashing? The better question is, are RTX's fundamentals getting stronger while the stock gets cheaper? If the answer becomes yes, that is when the dip becomes much more interesting for long-term investors. This video is for educational and informational purposes only and should not be considered financial advice. RTX's future share price can be significantly different from these estimates because markets, earnings, interest rates, defense spending, aerospace demand, and investor sentiment can change. Always conduct your own research and consider your personal risk tolerance before making an investment decision.